Welcome everyone to BDO's webinar, properly designed for professional services firms. For those who don't already know me, I'm Anna Jarrold and I'm a tax partner focusing on advising professional services firms. I know there's a number of specialists on the call today, so you may not have met me before, but welcome to our webinar series. So BDO, if you haven't come across it before, is the world's 5th largest accounting network. And we provide auditing, accounting and advisory and taxation services over 160 countries. So we've been long-standing advisors to the sector, and our national professional services team is one of the largest dedicated sector teams within a UK accountancy firm. So all of those nuances around what professional services firms need, we understand those. So through that strong sector focus, we work with a full range of clients, from those boutique firms, perhaps highly profitable, through to large international businesses, including partnerships, privately owned corporates, listed and private equity-backed businesses, of which there are more and more all the time. So today we're focused on the international elements. So let me introduce you to our speakers. We have Anton Hume, a transfer pricing partner and former partner, who's the lead of the transfer pricing operations for BDO globally. Anton acts for a number of sizable professional services practices, helping them devise, implement, support and defend and document transfer pricing policies, hopefully not in that order. So we also have Ed. Ed Gibson is an international tax partner, and Ed specialises in advising larger businesses on a range of international tax issues. He works both with businesses looking to invest overseas and those overseas businesses looking to invest into the UK. And he is the tax leader for global compliance and reporting at BDO. So on the agenda today, our speakers will be discussing transfer pricing. So what do you need to know? Recent and upcoming developments. And then also the changing face of TP controversy. Exciting topic. And then also Pillar 2. So a lot of change facing both transfer pricing and Pillar 2. And as always, we'll be running this webinar live. So please do ask questions as we go through it. There's a Q&A feature on your screen. Just click on that, drop a question in there, and we'll either ask those as we go along or pick them up at the end. If we run out of time or it's something particularly specialist, we'll get in touch afterwards and speak to you about that particular point. So as I mentioned, we'll finish within the hour and we'll share with you the slides and a link to the recording within a few days. So without further ado, over to you, Anton, transfer pricing.
Good morning, everyone. I'm going to gently lead you into the webinar. What I'll be focusing on today are recent developments, and in particular a focus on the new documentation requirements, but also give you an insight as to what we're going to see in terms of further compliance requirements from a UK perspective over the course of the next year. I'll then go on to talk about the areas that we're coming across that are being focused on by HMRC in the context of our experience of transfer pricing controversy and how that is developing. So without further ado, let's go to the next slide. As many of you will know, the UK now has a mandatory requirement for UK documentation in a format set out in the OECD guidance. The UK held out for many years and not adopting the OECD guidance, but has finally come to the conclusion that it really needs to insist that particularly more significant entities keep their documentation in that OECD format, which is a master file which sets out, as most of you will know, a broad picture of the totality of the business, and a local file for entities or possibly jurisdictions. That really depends upon the application of the way in which the guidance is implemented by particular jurisdictions. Local files for entities or countries that set out in granularity the transactions, functions and risks, supports the pricing, etc., etc. So the new requirement, mandatory requirement in the UK, applies to all companies that exceed the country by country threshold. The Revenue, however, in their guidance have made it very clear, and I've quoted them here, that their view is that the most appropriate way of demonstrating that provisions between related parties adhere to the arm's length principle is to prepare documentation in accordance with the OECD's recommended approach. And we see many instances where businesses that are much smaller than the CBCR threshold of 750 million euros have been asked to provide HMRC with a master file and a local file. And if they're not, they want to know why and how the existing documentation essentially provides all of the information that they would expect to see from those files. So let's move on to the next slide. So we have the master file and local file approach. I think what's important to say here, and I haven't said this yet, I'm afraid, is that the introduction of this mandatory requirement is for tax years commencing on or after the 1st of April 2023. So we're now well into it. The other thing, of course, is that documentation needs to be prepared in advance of when the particular tax return for the entity is filed. It needs to be provided to HMRC within 30 days of its request, although experience tells me that the Revenue can be pretty flexible about that if you require an extension. What many people forget is that there is an exemption for UK to UK transactions, except that doesn't apply, of course, to situations where the effective UK rate of income tax or corporation tax may be less than the regular rate, i.e. in the context where patent box is being claimed or where there's a ring-fenced trade like shipping. And the other thing is that only material transactions need to be documented in the local file. Now, that sounds quite exciting until you look at the detail, because it doesn't cover things like transactions in relation to which a profit split methodology might be applied. Doesn't apply in the context of intangibles. It doesn't apply in the context of strategic services, nor in the context of cost contribution arrangements, or where reorganizations have taken place, or where there's a cessation or commencement of a particular transactions. But nonetheless, it's there, and it applies to potentially exclude transactions that have a value. That's a transfer pricing value, arm's length value, for any particular category of controlled transactions, which is less than £1 million. Moving on to what we may have coming up over the course of the next year. And the first of these two issues has been long trailed. In fact, I saw a draft of a summary audit questionnaire which HMRC prepared almost a year ago now, but it's been pushed back and pushed back. But we definitely know that HMRC are committed to the introduction of this summary audit trail document. And the idea of the summary audit trail document is that it will sit alongside the master file and local file. It doesn't need to be filed with HMRC, but it needs to be retained in the event that HMRC asks for it. The broad idea of it is that it's essentially a document which sets out a series of questions to validate and give assurance that taxpayers are applying appropriate governance in relation to the maintenance of their transfer pricing and the support of their transfer pricing. The document, incidentally, is only required of businesses that meet the CBCR threshold. It's the sort of questions that certainly were in the original draft that I saw, were upon the lines of how regularly do you perform benchmarking, how regularly do you update your transfer pricing documentation, what instructions do you provide to your professional advisors that may be helping you support your master file and local file, and what are they delivering to you? How do you monitor the appropriate implementation of your transfer pricing? What do you do in the event that you find that there are errors? What's the governance around ensuring that those errors are properly addressed and embedded, corrected, and embedded in your procedures to ensure that those errors don't arise again in the future? So it raises some challenging issues. I think that we almost certainly will see a public consultation before this comes out. But my expectation is that we'll see this before year end. The other thing that has been trailed, but I think there's a less enthusiasm on the part of HMRC to introduce this, certainly not until the summary audit trail requirement is introduced, is the requirement for an international dealings schedule, rather similar to what you see with the in the US with 5471s and 72s, and in Canada with their T106s, and in Australia, who also have this sort of thing. The idea of the schedule is that details of cross-border transactions are provided within it. Essentially, it's as opposed to a narrative, which is what the summary audit trail contains. This is a numerical approach to detailing the value of transactions and the transfer pricing applied. On the right-hand side, you'll see a tall house. That really sets out what emerging themes that we are seeing in terms of effective risk management, underpinning compliance, and reflects some of the issues that I raised earlier in terms of governance and operational TP, and effective implementation. But of course, with any documentation, the challenge that the taxpayer has is balancing what are often exacting compliance requirements, because you're just not, of course, looking at the UK, you're looking at multiple jurisdictions and their particular and nuanced expectations vis-a-vis documentation. And, you know, on the one hand, and potentially containing that compliance, and on the other hand, commercially managing your transfer pricing risk. To put it crudely, do you really need to produce a local file for particular jurisdictions where, you know, the volume of transactions and the TP risk is very low? What is the alternative? The alternative might be a pro forma local file that you can populate very quickly, say within 30 days, when if a tax authority asks for that documentation, because you'll generally be given a period of time in which to produce the documentation. Let's move to the next slide. So the changing face of controversy and areas of focus. What are we seeing? Let's start with documentation. And I hate to be badged with the documentation TP guy. However, it is incredibly important to get this right and get the simple things right. Beyond the explicit requirement for a master file and local file, what other sorts of records should you be maintaining to demonstrate that your tax return is complete and accurate? Well, the first thing I've got listed here is intercompany agreements. Don't forget that in appropriate circumstances, intercompany, intra-entity in the contract context of a partnership with PEs and other partnerships and corporates within their group, in inverted commas, inter-entity agreements are important, and tax authorities will frequently ask for them. And again, you're faced with the balance between, well, do we really, in the context of intragroup financing here, need to produce numerous documents, you know, say up to 100 pages of detail, including covenants for intragroup lending, in the context of what a fairly minor intragroup balance is? Well, the answer is no, you don't. But there is some pragmatism to be applied in terms of the nature of the documented support that you have for those sorts of things. But they are important, not just from a tax perspective, and from the perspective of mitigating the risk of challenge from a TP perspective, but it really does help to underpin a tax authority's otherwise assumptions about where, for instance, charges are allocated, where IP within the group is actually owned, and they could be important from a regulatory perspective as well. So don't forget intra-entity agreements. The other thing from an operational perspective is to ensure that you've got things like, a framework for analyzing functions performed, standard operating procedures, calculation guides and process notes, for instance, in order to calculate the transfer pricing charges, tax risk and controls matrices to demonstrate that transfer pricing issues are identified and rectified, and other written policies that exist on transfer pricing governance. All of those things you should expect to be asked for in the unfortunate event that you come under inquiry. And I've seen HMRC ask for these sorts of things. The other thing to think about is risk. There is a particular focus by HMRC in the context of inquiries on risk at the moment. HMRC has spent quite some time putting together some comprehensive guidance, which they published, I think, in January of this year, on the control of risk and associated transfer pricing, which provides inspectors with essentially and taxpayers with guidance on how to analyze risk in the context of where control of risk is exercised, and also bearing in mind what entities have the capacity to bear it. So as with all of these things, HMRC will respect what is within contracts and within the documentation. But if they've got reason to believe that there is an entity in the group that really doesn't have the capacity to bear a particular risk that's allocated to it, it will seek to understand what entities in fact do. And the same with control of risk as well. So where is control of risk really exercised? Is it really exercised within the local entity, or is that risk really controlled out of head office? So there's some great guidance, I have to say. I was involved in helping HMRC to draft it on control of risk. Take a look at it. The other thing is intangibles, a long focus on intangibles in the context of professional services groups. What intangibles would you typically see? Well, you may have, for instance, some technology that those groups would employ and possibly have built upon to manage aspects of their business. But inevitably, the question that most commonly arises in this context is, well, can we charge for the name? It's an incredibly complex area, and the answer is sometimes yes, you might be able to, and sometimes it is certainly no. But when looking at intangibles, it is incredibly important in the context of your supporting documentation that you clearly identify what they are. You evaluate their value to the group, and in particular apply the benefit test to ascertain as to what entities are actually benefiting from those intangibles. And again, important to ensure that there's an alignment of control and functionality with the purported legal ownership. And that's done with specificity, to use one of my favorite words that's often used in transfer pricing language. Financing transactions are making their way up the list in terms of a favorite focus for HMRC as well. And in particular, the characterization of them. Are these things really loans, or are they something else? And looking at both quantum and pricing, as the UK legislation dictates the ones it needs to do in terms of determining the arm's length nature of any financing transactions. Critical is comparability in terms of supporting the pricing. That is quite a difficult area of TP. And then finally on this page, benchmarking. We're seeing HMRC increasingly and aggressively looking in granularity that benchmarking performed usually by professional services firms like us, benchmarking that's been prepared to support the pricing of particular transactions. And when I say aggressively, sometimes taking positions that you know, I would take the view are almost untenable, quite frankly. But anyway, my apologies for venting a certain amount of frustration on that particular issue, but we are seeing more and more challenges on that particular score. Let's turn to the next slide. And of course, there's the old favorites, questions being raised about whether the methodology is appropriate, the policies are appropriate, they've been implemented correctly, and in particular where there are changes and modifications to the policies that are being employed. That is an absolute red flag. And of course, the treatment of central group and local costs and the appropriate allocation keys applied to them. And whenever there are losses, well, the question is, well, why? Why are you bearing losses in this context? Possibly because you're not appropriately charging out to other group companies costs from which on services that subsidiaries benefit from. Let's turn to the next slide. I realize I've got a minute or two to close. My final slide is on operational transfer pricing. We're seeing a lot more focus on transfer pricing of governance processes and procedures. I mentioned earlier the SAT, which we can expect to see later this year, which is firmly focused on that kind of thing. But we're seeing the language used in the draft SAT that I've had sight of, which I mentioned earlier, in the context of business risk reviews, with the issues that are noted on this list being commonly raised. So I won't read through them. I'll leave you at your leisure to go through that list. There are more, but they will give you a nice indication of the issues that are being raised in the context of business risk review, written questions that I have seen in the last year.
Yeah, thank you, Anton. Thank you. Anton, just a really quick question on that SAT, that summary audit trail that you talked about coming in, expectation at the end of the year or whatever. Is that going to be part of the compliance documents that people are expected to maintain on a regular basis, or is that what might be asked for if there's an inquiry?
It's expected that it will sit alongside the local file and the master files. So it's expected that it will exist in conjunction with them and be regularly updated together with the master file and local file. When I say regularly updated, the expectation is that they'll be updated once a year.
Great. Thank you, Anton. Right, now onto something similar but different. Pillar 2. Ed, over to you.
Thank you, Anna. So in the next 20 to 25 minutes or so, I'm going to do a very quick reminder of the key components of the rules. I'm not going to go into a huge amount of detail on this because I'm conscious that many of you will have heard a lot of this already. But what I am going to do is just talk through a couple of technical points that are likely to be of particular relevance to this audience because they deal with transparent entities and how they get treated for Pillar 2 purposes. I'm then going to finish with some comments around some compliance related aspects. So what it is that you need to be doing, and what the disclosure requirements and filing requirements around Pillar 2 are, because a lot of that stuff is actually very topical at the moment, being as we're first period into the rules. So just to start then, quick reminder of what's in scope. So basically, multinational groups with turnover in excess of 750 million euros. That is measured across the previous 4 periods. So if you meet those thresholds for 2 of the last 4 years, then unfortunately you win the prize of being within scope of Pillar 2. There are certain exceptions, certain excluded entities, so they are listed in the middle of this slide, things like government entities, pension funds, international organisations. Important point to note here is that these are entity exclusions, not group exclusions. So even if you have, for example, if you're government owned or you're an international organisation, but you own subsidiaries that are not, then those subsidiaries are still within scope. So it's not a blanket exemption, which is something that we do get questions about quite often. There is a de minimis from the rules. So if you have a revenue of less than 10 million euros and profit of less than 1 million euros in a particular territory, then that does get you out of the rules in that territory. So that needs to be assessed on a territory by territory basis. If we move on to the next slide, please. So quick reminder of what it is. Basically, what these rules are trying to do is to get everybody up to a 15% effective tax rate in all of the jurisdictions in which you operate. And it does that through 3 components broadly. So the first of those is the income inclusion rule, which is the main rule, and that operates at the level of the ultimate parent entity. So whatever jurisdiction that is, that jurisdiction has the responsibility for collecting the top-up tax to 15% if there is any, and that collects it for all of the territories that are in scope, and it gets to keep it. So it doesn't collect it and pass it down to those territories. If it's collecting top-up tax, that is a revenue raiser for the ultimate parent entity jurisdiction. There's then ultimately also the undertaxed profits rule, which is a backup rule intended to mop up any territories that aren't caught by the main rule. And then the final component is a qualifying domestic minimum top-up tax rate, which is an optional thing that territories can implement if they don't want their tax revenue effectively being collected by the ultimate parent entity. So we are expecting most territories that are in Pillar 2 to implement this to protect their revenue base, and indeed the UK has. There are then safe harbours that apply to potentially greatly simplify compliance requirements where you meet one of those safe harbours. We move on to the next slide, please. In terms of approach to dealing with Pillar 2, we set out on this slide very high level 6-stage process that businesses need to go through. So the first of those is effectively a review of the group to identify which is your ultimate parent entity and is that in scope of the rules, and if not, where in your group structure is going to be subject to the rules. Then once you've done that, you need to consider whether or not you meet any safe harbours on a territory by territory basis. As I've said before, if you do, it's great news because your calculations in those territories are going to be quite significantly simplified. And then if you don't meet safe harbours, steps 3 to 6 are effectively doing the full scope Pillar 2 calculations in each territory in which you operate. So that's a much more involved process if you find yourself in the realms of having to do that. We move on to the next slide. So this is just a quick reminder of the safe harbours. So there are 5 of these. 3 of them run from the country by country report. So they use data from the country by country report and then use that data to perform certain calculations to determine whether or not you are in or out based on meeting a particular threshold. And then the other 2, so the 2 at the bottom, the QDMTT and UTPR rules, are standalone rules. So QDMTT is basically, are you in a territory that has implemented a qualifying domestic minimum top-up tax? If yes, great, you meet that exemption. The UTPR one is an exemption that applies in the ultimate parent entity jurisdiction only. And it's one that applies where that ultimate parent entity jurisdiction has a nominal tax rate in excess of 20%. And really, this is one that's just been brought in to keep the United States on side with the Pillar 2 rules, because otherwise they could have found themselves in a position where US multinationals were paying top-up tax in respect to US profits in other territories, which was clearly not acceptable to the Americans. The 3C by CR ones, so there's a de minimis one that applies same thresholds as the main rules. If your revenue is less than 10 million, your profits are less than 1 million. There's a simplified ETR one, which basically does a simplified calculation on a per territory basis to work out whether or not your effective tax rate is in excess of the threshold, which for the first year is 15%, but it does crank up in subsequent years. And then the last one is a routine profits exemption, which compares your profits in a jurisdiction to substance-based income exclusion, which is Pillar 2 jargon, which is basically a calculation that looks at what's your staff costs and fixed asset base in a territory, applies a percentage to that to arrive at that number, and then you compare your profits to that. And if your profits are less than that, then you're out on that basis. If you meet any of these, then your top-up tax for a jurisdiction will be deemed to be zero, and there is no need to do the full calculations, which is a potential significant win. If we move on to the next slide. So that was just a very quick canter through of the key components of the rules. I'm now just going to talk about a couple of things that are particularly relevant to professional services firms. And they both relate to how you deal with transparent entities in the structure for Pillar 2 purposes. So this first one is dealing with safe harbors and how transparent entities are treated for safe harbor purposes. So quite a simple structure in this example. We have a UK LLP that is wholly owned by a group of individuals, some of whom are in the UK and some of whom are in country B, which could be any country in this example. That UK LLP itself owns a LLP in France. So the French LLP is 100% owned by the UK LLP. There are no extra partners in this example. So from a safe harbour perspective, if we look first at the UK LLP, there's a specific set of provisions in the safe harbour rules that deal with situations where your ultimate parent entity is a transparent entity, which is the situation that we have here. And it says that if you have this situation, then potentially the profits or losses of that UK LLP in this example can be reduced to zero because they are deemed to be passed up to the partners for Pillar 2 purposes. And in order for this to be the case, it looks at what is the position of those partners. So the first potential get out is if those partners are subject to a nominal tax rate of at least 15%. The second one is if the partners are resident in the ultimate parent entity jurisdiction. So in this case, we have a UK LLP, so the partners would need to be UK resident, and less than 5% of the profits and assets of that LLP are attributable to each of those individual partners. There's also an exemption that applies where you've got entities that are partners in an LLP. So if the partner is a government entity, a not-for-profit organisation, international organisation, or a pension fund, then that would also be a qualified person, meaning that the profits of the LLP could be reduced by any amount that is allocable to those partners. So if you do fall into any of those, and if we assume in this case that the country B tax rate is in excess of 15%, then the profits or losses of that LLP would be wholly allocated to those partners. And then when you come to do the safe harbour assessment, you would, in this case, meet the de minimis one because there are no profits in the LLP that are within scope. of Pillar 2. Just looking at, I guess, just to make the point about the country B partners, I said that they would qualify if the effective tax rate in that jurisdiction was more than 15%. So they are only ever going to be able to qualify for the first of those two exemptions on this slide, because they're not resident in the UK. So if you have a partnership that has partners in multiple jurisdictions, it's important to understand whether or not they would meet that exemption to get all of those profits out for Pillar 2 purposes. We then look at the, sorry.
I was just going to ask you about companies, but if you're not moving off this slide yet, I'll come back to it.
Yep, I've got one more bit to cover and then we can, yeah, that's fine. So the French LLP, so when we come to look at the safe harbour position of the French LLP, its ability to qualify really depends on whether or not its profits are allocable to a permanent establishment. So if some or all of its profits are allocable to a permanent establishment, then that permanent establishment would get treated for Pillar 2 purposes as a separate entity. And in that case, it could then qualify if it meets one of those safe harbour exemptions that were set out on the previous slide. If it doesn't operate through a PE, then it's treated as a stateless entity for C/CR purposes, which means that it also cannot qualify for a safe harbour exemption for Pillar 2 purposes. Now, that may or may not have any practical implication, because when you actually come to do the Pillar 2 calculations, as we'll see on the next slide, it may be the case that there are no profits in that LLP anyway, because the profits get allocated to the partners, in which case it may not be a particularly big deal that it doesn't qualify, albeit there will probably still be some more administration in terms of having to prove that position when you do the full rules. So I was going to move on to the next slide, Anna. I do know that I think you have a question about what would happen if the UK LLP was a corporate entity. May just park that one for the next slide if that's okay, because I think it's probably more relevant for that one than for this one.
Yep.
If we move on to the next slide then. So this is just looking at how transparent entities are treated if you do find yourself in a position where you're having to do the full Pillar 2 calculations. When you're dealing with transparent entities, there's quite a clear set of rules that you need to apply for Pillar 2 purposes, which are set out on the right-hand side of this slide. So the first step is for any transparent entity, when you're calculating its profits and taxes for Pillar 2 purposes, you reduce its profit or loss by any amount that is attributable to non-group members. So we don't have that on this particular example on the left-hand side, but if, let's say, C LLP had another partner in, say, country D, and that another partner was not resident, was not part of the group, then we would exclude the profits that were allocable to that other partner from the Pillar 2 calculation for our group. The second step, similar to what we did for the safe harbour, is you would reduce the income and taxes by any amount that is allocable to a permanent establishment. So again, if C LLP had a PE in another jurisdiction, then that PE would be treated as a separate entity, and any profits allocable to that PE would show up in that separate entity and not in C LLP. The third step, if it's not an ultimate parent entity or a reverse hybrid, is that we would allocate any residual income or loss to the owners. If it is a reverse hybrid or an ultimate parent entity, those profits stick in that entity. And then finally, if it's an ultimate parent entity, we can consider whether any of that income or loss gets attributable to the owners rather than being stuck in the entity. So if we look at this, the example here on the left, so starting with at the bottom with C LLP, we've assumed it doesn't have any other owners and it doesn't have a PE. So if we click on there, the profits of C LLP would actually tier up into country C, which would mean that CLLP has profits of 0 for Pillar 2 purposes, and country C has profits of 150. So if we click on there, if we then look at B LLP, we've got, again, no non-group members and no permanent establishment. So we're into step 3, where we allocate it up to its members. So profits of 100, 60 of that would go to the individuals in country B, and 40%, so 40 of it would go to UK LLP. So again, if we click on there, and again, that means that we've got no profits for Pillar 2 purposes in BLLP and 240 of profits in UK LLP. So then the final step is to consider whether any of those profits in UK LLP can be allocated up to the partners. And it's the same rule as the one that I went through when we were talking about safe harbours. So looking at what the position is of those individuals who are partners in that LLP. And here, because we have UK partners in a UK LLP, provided that none of them are own more than 5% of the profits or assets, the full amount of that 240 could be allocated up to those UK partners, which would mean that we would have no profits showing up in UK LLP for Pillar 2 purposes. So in this structure, the only entity that would have any profits from a Pillar 2 perspective would be country C, which would have 150 of profits, but we would not have anything anywhere else. I believe you had a question on this one, Anna.
I'll unmute myself to be able to ask you the question. So we were talking earlier about the sort of structures of professional services firms, and there's more and more that are using both corporates and partnerships as time moves on and international aspects grow, etc. So what happened if there was, instead of it being a UK LLP at the top of your structure, if it was actually say a UK corporate?
So if it was a UK corporate, if it was above UK LLP, or if it was just instead of UK LLP, then it would be the same as we have with country C at the bottom. So those profits would tier up to that corporate entity, and then they would stick then for Pillar 2 purposes. So rather than in this example having no profits at the top, we would have 240 of profits in that top entity that would be subject to a Pillar 2 calculation.
Thank you.
Okay, so if we move on to the next slide, I'm just going to very quickly talk a little bit about compliance. So the rules, certainly in the UK, came in with effect for accounting periods beginning on or after the 31st of December 2023. So if you're a calendar year end, this is the first period that you are actually in scope of the rules, so period ending December 2024. And you'll need to do the full set of Pillar 2 processes, so looking at whether you qualify for safe harbours, potentially doing the calculations, and also importantly, reporting in your financial statements what the impact of Pillar 2 is. So this slide here just gives an overview of what a timetable for Pillar 2 compliance would look like. So the points at the top are the key milestones that you'll need to meet in respect of that first period. So the accounting ones on the left, and then the compliance related ones, the notifications and ultimately filing of returns on the right. And you'll notice that they actually do stretch quite far into the future. So just Q2 of 2026, quite a long lead in. But there's also a lot to do. So if you look down the left-hand side of this, that's sort of detailing at a high level what the steps are that you'll need to go through to make sure that you're compliant. So the first of those is around deciding on your strategy, making sure that your data is ready and updating systems and processes accordingly. The second area is just looking at safe harbours, so doing those safe harbour assessments. And I will say it's not just as simple as running the calculations that I've just shown you. There are further steps that need to be done to make sure that actually the data that you're using for those safe harbour assessments is fit for purpose and meets the qualification criteria. And then the final element to it is the compliance and reporting part. So earlier on, doing the accounting disclosures, including appropriate things in your annual reports, but then later on, actually doing the Pillar 2 calculations, filing your returns, and potentially paying top-up taxes where they are due. We move on to the next slide, please. Just a couple of comments on compliance strategy, which I alluded to on the previous slide. Really, the key thing to think about here is where you want to sit on the in-source versus outsource continuum. So on the left-hand side here, you may choose that you want to do this fully in-house. So do all the calculations yourself, file the returns, and basically keep it as an in-house job. Or you may choose that, no, you want to get an external provider to help you with that. And that may be anything from a fully outsourced solution where they are doing most of the work for you, or perhaps something in the middle, a co-source type arrangement where you're splitting responsibility between your internal team and the external provider. Irrespective of where you decide to sit on that continuum, there are certain things that are always going to be applicable. So deciding whether or not you want to have a separate approach for compliance and reporting, or whether you want to take the same approach for both. Making sure that your data is fit for purpose. So even if you fully outsource everything, if your data is not good enough to do the calculations, that external provider is not going to be able to do those calculations. So that is something that's going to be really important, irrespective of where you choose to be on this continuum. And you need to update any governance and training internally. Importantly, outside of the tax team as well, because this is something that potentially affects the whole organization. So everyone in your organization needs to be aware of these rules, and it needs to form part of any future business planning decisions or strategy, because this will be a key component of your taxes going forward. We move on to the next slide. So in terms of disclosure requirements, so first set of disclosure requirements on here is just for 2023. So that was not a Pillar 2 period anywhere. The first period that anyone will have the rules in is the period ending 2024. But there are certain disclosure requirements that need to be included in accounts for that period. So two things broadly. The first one is that there is a temporary exception from a requirement to account for deferred taxes arising from the implementation of Pillar 2, and you need to include a disclosure in your accounts to that effect and to say that you have applied it. The second requirement is that you need to include a disclosure in your statutory accounts about the expected effect of Pillar 2. And that has a quantitative and a qualitative element to it. And what that means is you need to give information to the users that would allow them to reasonably understand what you expect the impact of Pillar 2 to be for your organisation. So that may be, for example, saying that you expect Pillar 2 to apply in a certain number of the group's territories, and then give an indication of the effect of that in terms of effect on ETR or effect on overall tax charge. We move on to the next slide, please, just conscious of time. When you're actually in the period for Pillar 2, so for 2024, that temporary exception continues to apply for deferred taxes, and as does the continued requirement to disclose that. But you then obviously need to include any Pillar 2 taxes that are going to accrue in that period in your tax charge for the period. And that needs to be disclosed separately from other income tax results in the period. So it can't just be all washed into one single number. We move on to the next slide. This is just then thinking about what the implications of that are for your processes. So obviously you need to do these calculations. So this needs to form part of your reporting cycle, and you need to make sure that your processes are updated accordingly to be able to accommodate that within your reporting cycle. As part of that, obviously, there's a need to do potentially quite complex calculations. If you're doing that internally, what the tooling requirements are around that, and there are quite a few packages on the market at the moment. And then finally, a point I've already alluded to, which is that you need to update your processes and governance protocols and build in enough time to enable you to do these calculations within the deadlines that you have for reporting. And I think that was all of the slides that I had, finishing with 5 minutes to spare.
Excellent. Thank you, Ed. Anton, thank you as well. We've got a couple of questions, got a couple of minutes to cover those off, and see if you can keep your responses as high level as possible so I can get through a couple of them. So Ed, a couple of questions for you. Have you considered the application of the joint venture rules, as it appears that any joint venture, irrespective of size, falls within the scope of Pillar 2 rules calculations and requires separate ETR calculations?
I have, and as the questioner correctly identifies, joint ventures are quite a complex area within Pillar 2. So if you do have joint ventures in your structure, they do need a particular focus quite early on, because they do fall in scope. The calculations are quite complex, and the added problem that you tend to find with joint ventures, certainly the ones that we're seeing, is the ability to access the data, particularly if that joint venture's on a separate reporting system, or if there are different processes there, or heaven forbid, it has a different year end from your main group. So there are quite a lot of things to think about from a joint venture perspective, which definitely need to be looked at up front.
Great, thank you. And the joint venture for these purposes are what, owned by separate parties, or,
Yes.
you know, what about when we talk about a group within a professional services firm? You know, it could be partnerships that own different interests in things, or corporates that are split in terms of their ownership.
Yeah, so partnerships are a bit more complicated because of the way that those tiering up rules work. For joint ventures, you're generally looking at situations involving corporates, and joint venture is usually a deadlocked 50-50 joint venture to be within the definition of joint venture. If you are over 50%, then the joint venture would be consolidated into your main results, and therefore it wouldn't be treated as a joint venture under the rules. It would be treated as effectively part of your group, albeit there are then further adjustments that need to be made. So yeah, it's quite a knotty area to look through, really.
Yeah. And there's a question here about when you've got globally mobile people, and often that comes with partnerships as well, partners as well as the employees of the partnerships. Have you considered the substance-based income inclusion rule calculations when you've got these globally mobile individuals?
It's not something that we've had to look at as yet, but it will obviously be quite tricky, because you're then having to look at, because the substance-based income exclusion looks at what your salary costs are in respect of people in that territory. And so if you've got globally mobile people who are moving around between entities and incurring salary costs in different entities, then that has an implication for that calculation. But it's not something that we've come up against yet, but it is a very good point that does need to be looked at if you do find yourself in that situation.
And there's a similar question on the transfer pricing side for Anton, actually, around, you know, the impact of globally mobile partners, globally mobile people, and the impact on transfer pricing. Was there anything in particular you're seeing on that front, Anton, in 30 seconds?
It can be complex. One needs to identify which entity the revenue is arising to, how the particular partner, if it's a partner, is being supported by other staff, for instance, in other locations. So yeah, complex, but by no means insurmountable in terms of addressing.
Yeah, helpful if you know what people are doing as well. Wonderful. Thank you both. Been really, really insightful. Obviously, a lot of change that's occurring in both your areas of focus. Also, an awful lot for clients to take on board in terms of making sure that they're allocating the right resources to each of these areas and knowing what's coming down the track. So thank you both. We'll end the call here, and we'll circulate the slides and the recording of this webinar, as I said before, in due course. I hope everyone has a great day. Thank you very much.